The whole market just got rattled by some ugly inflation numbers, sending Bitcoin for a tumble. But is this a reason to panic or a massive buying opportunity? While some traders are pointing to the Producer Price Index, PPI, report as the cause for the dip, others are looking at the bigger picture. We're seeing guys like Crypto Rover open up new altcoin positions, betting big on Ethereum's strength and a coming rotation. He's pointing to huge buys from BlackRock and Tom Lee's firm as proof that the smart money isn't scared. Meanwhile, a new NASDAQ-listed company is making a huge bet on Toncoin's future with Telegram's 30 million users. The data shows corporate treasuries are quietly scooping up assets. So, is this just another shakeout before the real fireworks begin? In the latest video from Crypto Rover, he breaks down the recent market action after Bitcoin got a knock from hotter-than-expected PPI data. Bitcoin saw a rejection right from the $122,000 resistance level he'd been talking about, causing a quick drop. Despite this, he thinks Bitcoin's overall structure still looks good as long as it stays above its daily EMA ribbon. His bull market target for Bitcoin remains at $137,000. What's really catching his eye, though, is Ethereum's strength. While Bitcoin dipped, Ethereum had a strong bounce, which he sees as a clear sign of accumulation and power in the market. He references another trader, Polaris, who pointed out that back in 2021, ETH had several 20 to 30% corrections before it smashed its all-time high. He believes a similar pattern of setting higher lows is happening now. Because of this, he's opened new trades on altcoins like Arbitrum, Optos, and Tau, expecting a big money rotation soon. He's aiming to take his main profits on his Ethereum trade around the $6,500 mark. He points to some big factors backing his confidence. Google search interest for altcoins is at an all-time high. BlackRock just snapped up over $600 million in ETH, and Tom Lee's firm is reportedly raising another $20 billion to buy even more. He feels we're in the last 6 to 7 weeks of the cycle, a period that's historically been the most profitable, making it a bad time to bet against the market. It's interesting to see his conviction, especially in Ethereum, in the broader altcoin market. The data on ETF inflows from giants like BlackRock is undeniably a massive vote of confidence and changes the market structure. However, the idea that we are on a clean, predictable 6 to 7 week timer for the cycle's peak feels a bit too perfect. The market loves to throw curveballs. While search interest for altcoins is spiking, that can also be a sign of late-stage retail enthusiasm, which sometimes precedes a correction. The ETH Bitcoin chart has indeed shown life, but it's now up against some heavy historical resistance. A major rotation into altcoins depends on that chart truly breaking out and sustaining its momentum, which isn't a given. His strategy seems to be front-running that potential move, which is where the big gains are made, but it also comes with higher risk if Bitcoin decides to suck all the oxygen out of the room again. In the latest video from the Crypto Tips channel, they break down how to actually read on-chain data without falling for common traps. A lot of people think that the blockchain never lies, but it's easy to draw the wrong conclusions. For starters, a huge spike in new wallets doesn't automatically mean a wave of new users is joining. It could just be one person or a bot creating hundreds of wallets for things like airdrop farming. The video suggests using dashboards on Dune Analytics to see a clearer picture of real usage and tracking daily active users on L2 platforms through L2Beat.com. This video is especially relevant right now. It feels like the simple days of just watching Bitcoin flow off exchanges to gauge market sentiment are long gone. The crypto space has gotten so much more layered with L2S, restaking, and complex DeFi protocols. What used to be a fairly clear signal 5 years ago is now just noise unless you know exactly how to filter it. The tools mentioned are no longer just for hardcore analysts. They're becoming necessary for anyone who wants a genuine sense of what's happening. The market has moved on from simple wallet watching to understanding entire interconnected ecosystems, and it's easy to get left behind if you're still relying on old, basic metrics. In the latest video from Mark Davis, he breaks down why the crypto market is seeing a pullback. The main culprit is the Producer Price Index, PPI, which came in hotter than expected at 3.3% versus the anticipated 2.5%. This is freaking everybody out because it suggests consumer inflation, CPI, might spike in the coming months. making it less likely the Fed will cut interest rates. It's fascinating to see the market get rattled by short-term macro data like the PPI report, while a much larger structural change is happening in the background. The fear over the Fed's next move is temporary, but the trend of corporate treasuries adding assets like Ethereum and Solana is a more permanent shift. The $27 billion ready to flow into ETH isn't just a number. It represents a fundamental change in how corporations view digital assets beyond Bitcoin. This quiet accumulation by companies and the increasingly pro-crypto stance from U.S. regulators are powerful undercurrents. While daily price action is driven by inflation news, the real story seems to be the slow and steady integration of crypto into the mainstream financial system. In the latest video from Coin Bureau, Nick gives us a look at Palantir, a company that's as powerful as it is secretive. It all started back in 2003 with Peter Thiel and the PayPal Mafia. They took the fraud detection technology they built for PayPal and repurposed it for a post-9/11 world, hoping to spot terror attacks before they happened. After an early investment from the CIA's venture capital arm, Palantir became a go-to tool for intelligence agencies. The video does a fantastic job of laying out the bull and bear arguments for Palantir. What really stands out is how the company has made itself indispensable to its clients, especially governments. It's less of a software provider and more of a deeply integrated partner, which makes its revenue from that sector incredibly stable. Recently, Palantir secured another massive contract with the U.S. Army for its Titan program, showing its relationship with the military is only getting stronger. The real question mark remains its commercial business. While the growth numbers are impressive, the company has to prove it can become as essential to the corporate world as it is to the Pentagon to ever justify its current stock price. The valuation is undeniably steep, but Palantir isn't playing the same game as other software companies. It's positioning itself as a piece of critical national infrastructure, and that's the expensive bet investors are making. In the latest video from the Cryptos Rush channel, the host breaks down today's market dip, explaining why you shouldn't panic. The whole thing kicked off this morning with a bad inflation reading. The producer price index, PPI, came in at 0.9%, way higher than the 0.2% everyone was expecting. This news spooked Wall Street, leading to a sell-off that pushed Bitcoin down from around $124,000 to the $118,500 level. The video correctly points to the hotter-than-expected PPI report as the trigger for the market's recent dip. It's interesting to see how sensitive crypto has become to these traditional macroeconomic indicators. While the host frames the massive liquidation event as a healthy reset, it's also a stark reminder of the extreme volatility that leverage introduces into the system. These events often wash out short-term traders, but they can also create buying opportunities for those with a longer-term perspective. The market's ability to hold the $117,000 support level after such a shake-up does suggest there's still a lot of strength and buyer interest present. In the latest video from Crypto Banter, Rand starts by brushing off the recent market dip caused by hot inflation numbers and a misleading statement about the U.S. government not buying Bitcoin. He argues it was just a shakeout, and he's still very bullish, predicting Ethereum will break its all-time high in less than a week. The main event, though, is a conversation with Manny, the executive chairman of a new NASDAQ-listed treasury company for Toncoin called Verb. This interview really puts the Toncoin situation into perspective. Manny's comparison to MicroStrategy and BitMine isn't just hype. It's based on a financial structure that has proven to work. The real story here is the distribution. We just saw the Notcoin game on Telegram bring over 30 million users on-chain in a matter of months, which is a scale other blockchains can only dream of. That event validates the core idea that Telegram can onboard a staggering number of people into crypto almost effortlessly. When Manny talks about a stablecoin and a trillion-dollar opportunity, it sounds less crazy in that context. Still, the market is clearly spooked by Pavel Durov's legal issues in France, which is likely what's keeping the tampon price suppressed relative to its peers. It feels like a high-stakes bet on whether Telegram's massive user base can overcome the regulatory clouds hanging over its founder. In the latest video from The Modern Investor, the host kicks things off by talking about PayPal's new Pay with Crypto service. He explains that while PayPal is promoting this as a way for merchants to easily accept crypto and reach 650 million users, it's actually an unnecessary step. The host argues that the entire point of blockchain is to get rid of middlemen like PayPal. Anyone can already accept crypto directly with a simple wallet and a QR code, avoiding the extra fees that PayPal will inevitably charge. He sees this, along with similar moves from Visa, as a desperate attempt by old financial institutions to stay relevant in a world where peer-to-peer transactions are becoming easier. While he admits it might help with adoption, he feels the real story is that people don't actually need PayPal for this at all. The host's take on PayPal's crypto ambition seems pretty spot on. It's less about innovation and more about self-preservation. Since this video was made, PayPal has even launched its own stablecoin, PYUSD. This move solidifies the idea that they aren't just trying to facilitate crypto payments, they're trying to build their own ecosystem within the larger crypto world, keeping users and fees within their own walls. It's a classic strategy for a legacy company trying to control a technology that was designed to be uncontrollable. As for Uruguay, the trend of smaller nations creating favorable crypto regulations is only accelerating. They're in a race with neighbors like El Salvador and Paraguay to become regional fintech hubs. It's a clear signal that governments are starting to see the economic upside of embracing this industry instead of fighting it. In the latest video from CryptoJeb, he gives a step-by-step breakdown of a successful Bitcoin trade he recently made, turning a profit even while the market was in a general downtrend. He explains his strategy, which hinges on two key concepts he calls the action line and the safety line. Jeb spotted an entry when Bitcoin broke above its downtrend, the action line, and also pushed past the important $118,000 price level. This signal, combined with a bullish RSI divergence on the 30-minute chart, prompted him to open a 20-day long position. After entering the trade, he watched for an uptrend to form, which he labels the safety line. He then used this rising trend line to manage his stop loss, moving it up as the price climbed. The trade was closed for about an 11% profit when the price broke below this safety line near $119,000. He wraps up by showing a current chart, pointing out another potential setup he's watching as Bitcoin tests local bottoms. Jeb's use of action lines and safety lines is a clever way to simplify a classic trend-following strategy. It's essentially just using trend lines for entry and exit signals, but his naming convention makes the concept really accessible for traders who are just starting out. It's worth noting that while this trade worked out perfectly, this kind of strategy can be tricky in choppy markets where false breakouts are common. The fact that he layered in other confirmations, like the RSI divergence and the break of a major volume level at $118,000, shows that his real strategy isn't just about drawing two lines. It's about waiting for multiple signals to align before pulling the trigger.